What's going on, everybody? Welcome to a Capital Hungry Market Analysis and Trade Ideas webinar. It is currently 5:30 p.m. Eastern, end of the North American trading session, Tuesday, August 22nd. We're just going to be continuing from our previous Market Analysis and Trade Ideas webinars with a couple of updates as we have some more important economic data in focus over the coming sessions. Now, a quick overview. Overall, we've been playing the narrative of rates being up higher for longer, and of course, more demand in the US dollar and US Treasury surging as well. This has kept gold a lot more bearish and subdued, where on the higher time frame, we've been anticipating some corrective sells and bearish plays ever since we retested back into the 1990s and 2000 price point. We understood that this is a very important fundamental price point where we've only seen gold buyers hold above for a very short period of time, and we've only seen gold break above the 2000s with high impacting fundamental catalysts and new events that were being priced in. In this situation, it was obviously the 2020 pandemic fear, money pumping phase into the markets there, and the global lockdowns. This situation was Russia invading Ukraine. This situation was the banking sector failures, where we had the SVB collapse in the US, followed by Credit Suisse and Eurozone and so forth. But you can see every time we have these major fundamental catalysts, the upside above 2000s is very short-lived, only lasting a maximum of a week in this example of the banking sector failures. And then we see very aggressive profit taking by the whales at these highs. And especially in the higher interest rate environment we are still in, you can see we also get this retest of the 1990s to 2000s before a pretty consistent leg down. This is something that I described in the last couple of market analysis and higher time frame webinars, and why we have been in more of a bearish bias here ever since the 1990s, and also understanding the sentiment of more demand pooling back into the dollar, with the narrative of rates being up higher for longer starting to come back into play and starting to shake out some of those stock market buyers. Some of the data that's been supporting rates up higher for longer is US economic activity still remaining resilient, with a healthy labor market, relatively healthy PMI figures, retail sales, and other consumer data still being very resilient, not showing any major impact of Fed policy lag effects just yet. We're also seeing fluctuations with CPI reports to the upside as the base effect of 2022 has been passed. And of course, we're showing a lot more trouble back into what we call the sticky zone of inflation at 2 to the 4% range, right? So that has really been still supporting the narrative of rates being up higher for longer, which has led to a further outflow on gold, that correction on the stock market we called in the example of US 30, and more demand in the dollar. But one thing we have to look out for is very aggressive corrective waves that can take place. So you can see, even in these previous examples, like here, at very similar price sensitivity areas, as Russia and Ukraine got priced in, wasn't holding any more weight as the market took advantage ahead of time, and we weren't really getting any new events adding on to it. As the Fed started to give signals towards their most aggressive rate hike cycle in history, we had very clean bearish downside moves after rejecting into the 2000s there, right? But the one thing we have to be cautious about in the perspective of manual retail trading are these aggressive pullback waves. It might not seem like much what I'm highlighting in these yellow circles here within the overall macro bearish move, but these are pullback plays that can extend hundreds of pips on the intraday timeframes. And also what is important to take into consideration is the length of time these pullbacks can extend for. You can see some of these pullbacks lasting a period of days, sometimes even a week before continuing the overall trend. Here you can see a much more aggressive pullback phase while still maintaining bears in control. Now, one thing we have to be cautious about is we've had pretty smooth sailing sells when you understand how gold behaves from the 1980s down. There's been minimal secondary phases of market structure or any corrections. But on the daily, we are starting to get our first signs of exhaustion roughly around the 1890s there. And we have to anticipate that we could easily see some pullback phases, even setting up prices for Friday, Jerome Powell's Jackson Hole Symposium, where he could bring some more hawkish pressure. And the way he would do that would be removing the hopes of rate cuts in 2024. We need Jerome Powell to price out rate cuts in 2024 because that's what the greedy stock market buyers have been hoping for. That majority of the front loading of rate hikes are complete. They've been hoping for the soft landing narrative, which is basically bringing inflation to 2% targets and maintaining it there without any major sacrifices in the economy or any recession, which is almost near impossible to do, but that's what the greedy stock market's been riding on that entire bullish phase. So if Jay Powell comes to the table and cuts out those hopes of 2024 rate cuts and even discusses more rate hikes and keeping neutral rate up higher for longer, this will for sure bring the focus back on the tightening cycle by the Feds, still lead to more demand in the dollar and outflow out of gold. But I would love to see some aggressive pullback phases to retest some better sell zones of interest before that takes place. And this slow correction phase may take place over the next couple of days, as we still have some economic data reports to go through, and as we're starting to see some minor exhaustion here from the 1890s. So a quick review here on gold. We're still obviously macro bearish, and we understand exactly why we've been playing those bears below the 2000s. Very similar price repetition with a short-lived fundamental catalyst holding above the 2000s. Whales liquidating positions, getting a shift in sentiment there, short sellers entering from better prices. And then in this instance, you had the front loading of rate hikes. In this instance, we're still maintaining rates above 5%, rates up higher for longer narrative, and still seeing more demand in the US dollar for that reason, right? But the one thing we have to be mindful about is as gold has this downside, which was a lot more aggressive here, the post-pandemic phase, when obviously the pandemic was going on through this entire timeline. I just mean when the market stopped giving a shit about it because the events were priced in, you can see very aggressive pullback waves on the intradays are common. Now, I don't really want to be seeing price movement like this because this is excessive, very volatile, very hard to trade. You have to remain very vigilant and sharp with price movement here. But I would love to see movement like this where we can still get some aggressive intraday pullback phases while continuing the overall bearish move, giving us great price points of interest to retest into, setting up better sell positions before continuing this bearish move and trend. Now, the one thing we have to look out for on gold is obviously policy lag effects working its way through the economy and economic data starting to get a lot worse. But for the time being, any bad data reports on the US side leading to short-term appeal to gold's safe haven side is just going to lead to data-induced pullbacks, in my opinion. So even if we get some bad data tomorrow or show any signs of softening with the figures we're going to be reviewing, in my opinion, that'd be a perfect catalyst for sellers, which we're already seeing exiting positions from these lows, buyers jumping in hand, creating a data-induced pullback phase, which could easily still retest into the 1920s, like nothing at all here on gold, and then setting up prices for the Jackson Hole Symposium for Jay Powell to fade out the hopes of 2024 rate cuts. Now, the one thing we have to be mindful about with the Federal Reserve is they can take a much more slow and steady approach. It's not like the crisis period of 2020 when they were massively stimulating the markets and creating these and doing these very aggressive decisions every single meeting. And it's not like 2022 when they were starting their most aggressive rate hike cycle in history, aggressively front-loading hikes and still taking monstrous actions every meeting. Now they can stretch actions across multiple speeches or multiple FOMC meetings instead of piling it all into one, which is what we've been seeing with the last few FOMCs, just being copy and paste statements, nothing new being brought to the table, them taking a slow and steady data-dependent approach. That's one thing we have to look out for. That is very much a high probability with Powell at the end of the week. But what would be ideal is him starting to take away some of the rate cut hopes, bringing back more of the hawkish pressure, leading to more demand in the dollar. And after gold has a pullback phase, still leading to an outflow out of gold and an outflow out of the US equity markets there, right? So the main reason equities have been more bearish is the rates up higher for longer narrative starting to get faded out, but we still have to be very mindful of this accumulation area and retest of a previous liquidity zone around 34,250, 34,300. If we don't break below, we can still get some aggressive pullback phases, buyers trap, setting up better prices for a hawkish J Powell, or obviously we still need the breaks below 34,200 to be extending any further sells, and we need confirms for that. The same fundamental reason is why dollar has been so bullish. Now, dollar has seen some very aggressive waves, which has been caused by currency interventions from countries out of the Asia region, including China, which has been doing some currency interventions amidst their surprise rate cuts due to the rapid devaluation of the Chinese yuan against the dollar. And of course, we've even seen India doing that. And there's been this lingering fear of watching the Japanese government very closely as we're reaching levels on UJ where currency interventions can become an increased probability. I personally think Japan is still more on the back burner right now. We're not seeing excessive volatility on the Japanese yen decline. And I can see UJ reaching to levels of like 150 before really starting to see any currency intervention. But it is still lingering if dollar starts to increase in value at a rapid volatile rate. Remember, as long as Bank of Japan keeps interest rates in the negative and their unlimited bond buying program going and stimulating their economy, yen weakness is inevitable. And especially with the macro rate differential of a more hawkish Federal Reserve versus a more dovish Bank of Japan. Same thing with China doing surprise rate cuts and stimulating their economy due to the excessive decline within their economic activity and the crisis fears that are developing. It's inevitable that the Chinese yuan is going to devalue. And it's inevitable that dollar is still going to be increasing in value. What they are trying to control is the volatility, the speed, the rate of which these currencies devalue and dollar increases in value. If that becomes too excessive, then you really start to see problems and negative implications for these countries. And that's when they're going to jump in and do some of these interventions, right? So dollar's been bullish, but the upside's been relatively subdued and controlled, which we can see with these intraday waves. Overall, we're still in a dollar bullish bias. I would love to see a pullback or price setup that's data induced with any declining US data or just price setups with Jackson Hole Symposium before still continuing dollar upside and maintaining that demand there, right? So on a higher time frame perspective, we've been watching this area to retest around 101 to the 102 price point for an extended period of time. We already anticipated, looking at some key historical price points of interest, that this was a very important area where even during the dollar domination phase we coined in Capital Hungry during 2022, where the Fed did their most aggressive rate hike cycle in history, we saw a lot of buy orders accumulate here. We had this little bit of a fake out to set up order flow for the new quarter, but are still maintaining price above this key area. And it looks like dollar still has legs up to go to the 105, 104.5's 105 handle here, right? So dollar bulls still look good, but I'm expecting dollar upside on the intraday to be moving up in this fashion, seeing aggressive pullback waves either induced by short-term weak US economic data and the macro still holding the most weight of rates being up higher for longer, or if volatility gets too aggressive, seeing short-term event-induced pullbacks, which the event would be currency interventions from these countries like India, China, and Japan. Overall, with this type of movement, I'm still expecting us to chug away into these prices around 104.5 to the 105.5. Still playing the dollar strength bias, of course, as it's your world reserve currency, and taking advantage of that positioning on Euro USD shorts, GBP USD shorts, USDCAD buys, and UJ buys, right? On our yen pairs, especially on pairs like GBPJPY and USDJPY, we've been playing the macro rate differential between the Bank of Japan and the Bank of England, and of course the Fed versus the Bank of Japan. So in the example of GJ, macro still looks like, especially as Brexit is over now, that we're going to be going back to pre-Brexit crisis prices. I always have to say that slow now. Otherwise, I'm going to catch myself in an embarrassing tongue twister. So it looks like we're going to be heading back to pre-Brexit crisis prices here, which is in the 192s. Obviously not in a straight shot, but over the period of the next couple of weeks and months, give or take some pullback phases winding into the end of the year, if we don't have any major geopolitical tensions to shift sentiment and bring fear, uncertainty, and doubt, if Bank of Japan is sticking to the same guns of keeping interest rates in the negative and aren't giving any signs towards significant yield curve control or rate hike signals in the near future, and of course, Bank of England still needs to stick to their guns of keeping rates up to combat inflation towards their goals, then give or take some pullbacks, GJ is still going to be chugging up into the 190s here. So on the macro, we're still playing yen weakness, dollar strength, gold bears, stock market bears, but we have to be mindful of a pullback phase and buyers trap potentially before continuing lower. And I just wanted to give that quick review before we really start jumping into the intraday and what events we have going on. So now let's look at what we have on the schedule today. So actually just an hour from now, for our NZD pair traders, we just got some retail sales, still expected to be relatively poor data in a higher interest rate environment. But we don't really be looking at too many NZD pairs, just something to keep an eye out for if you do trade that. Then we got some PMI figures, manufacturing services composite for Australia there into pre-Asian hours. And then into Asian market hours, we got some PMI figures, same collection of reports for Japan. Now, Australia's PMI figures can still be below the 50 grade point, as they're going to be feeling the impact of policy lag effects, a higher interest rate environment, coupled with inflation still being at elevated levels. So we could still see the data being around forecast below the 50 grade point. With Japan PMI figures, we should see still relatively strong data because Japan has been flooding liquidity into its system, financial system, obviously, with their unlimited bond buying program. They're keeping interest rates in the negative. They're trying to accelerate inflation and economic activity. So these figures should still be relatively in healthy ranges, in my opinion. Then overnight through the London and Euro session, we have PMI figures from 3:15 a.m. Eastern all the way to 4:30 from France, Germany, Eurozone overall, and then the UK. Now, what we're expected to see is these figures starting to slide and show signs of contraction and weakening for the same reasons that I said for the Australian economy, right? But projections are already skewed to the downside. Forecasts are very important in how data is actually digested and translated. If we just come out on forecast or just a little bit below it, even though it's lower than prior, it's not really going to hold that much market weight because it's priced in and within expectations. If we want to see this data bring more of a negative sentiment for euro pairs and for British pound pairs, it's going to have to come out lower than the poll and either lower than minimum expectations or right around minimum expectations, which you can see in this column here. I can see it being pretty much around forecast, just leading to some skewed lower time frame impact. But we should start to see declines in economic activity in these countries that have been keeping rates up higher for longer and combating inflation, as policy lag effects are going to be working its way through the economies. Then at 8:30 a.m. Eastern, we have some retail sales for CAD, going to be impacting USDCAD more than likely, even if it's slightly rebounding, as Canadian inflation has trickled back down to baseline levels, right? Then it's just going to lead to a short-term pullback on USDCAD while still maintaining overall intraday bullish structure. What's really in focus for us tomorrow for US dollar pairs, US equities, and gold are the US PMI figures. If these PMI figures are showing signs of contraction, aka policy lag effects making its way through the US economy, on top of all the signs of all the liquidity through the 2020 pandemic stimulus phase starting to get dried out, then this can bring some intraday fear through the North American trading session, lead to a data-induced pullback and short-term bears on the US dollar, and potentially be fueling the pullback and bounce on gold to be retesting better sell areas going into the Jackson Hole Symposium, in my opinion. So we do have potential where we may see some contractions in these reports. Otherwise, if we want to continue gold sells and dollar bulls cleanly tomorrow, this data will still need to remain optimistic, which is being better than the forecast here. Okay. Nothing really going on from a central banking and political perspective. Just, of course, got some of these BRICS leaders meeting just to take up some noise and distractions within the media, something we're not going to really be focusing on in Capital Hungry, because unless they bring something groundbreaking to the table that's actually going to hold market weight and impact price, we don't really give a shit what's going on with BRICS. Now, when we're looking at gold, so obviously we've been playing these bears, but we're seeing clear-cut signs of exhaustion around these lows at the 1890s. This is showing me we're not having enough seller volume in play to be extending trend, and we have the potential for a pullback phase to retest better sell zones, which in my opinion could easily go into like the 1915s and 1920s. So if we don't, in this general area here, so if we fail to print any new lows and start to break above this consolidation zone and accumulation area, and especially if we get some weaker US economic data tomorrow, this is going to lead to a data-induced pullback with short-term bears on the dollar, which over the next sessions and days can easily retest into the 1920s there before starting to get faded out and bears come back into the market from better intraday price positioning, right? So when we're looking at gold, very difficult to see any further continuation sells unless we get dollar soaring into new highs, gold breaking below the 1890s. Otherwise, we're starting to identify way more signs of exhaustion here and the potential for data-induced or normal price positioning pullbacks to even set up, in my opinion, for a hawkish Jackson Hole Symposium at the end of the week if Jay Powell kills those rate cut hopes in 2024. So now when we're zooming in, we can see we've had very clean bearish price action based on price points of interest, where this intraday bearish price action would be invalidated is us pretty much trading above the 1900s. Above the 1900s, we could easily retest into this prior accumulation area here, roughly into the 1920s, for an extended deeper pullback phase, which is normal on gold, before fading it out and seeing sellers come back into the market. So it's very difficult for me to see any further sells on gold with all the signs of exhaustion here without a fundamental catalyst of very optimistic US data or continued surge in dollar demand, and without breaks below 1888 here. Otherwise, what looks increased probability is seeing a pullback phase take place. Bringing that information together to the table, give or take the new daily, just setting up and making a lower wick. If we hold above 1897, above 1902, I would be looking for pullback buys to retest into these better sell zones, which I would prefer to retest into the 1920s before fading it out. But on the intraday, I would also be looking at where we've seen an accumulation of seller order flow before extending lower. I would also be checking the 1912s as a first area of interest, with any rejection confirms dollar strength coming back into the table and breaking out higher at the 1912s. Otherwise, any safe continuation sells, we need to be clearing the lows. We need to validate more seller volume. We need to validate optimistic US data and more demand in the dollar. GBPJPY. Overall, we've been playing the macro rate differential, very bullish structure, very bullish price action. We're just mindful of corrective waves that can take place. Now, something we have to be mindful of is we're starting to get our first signs of exhaustion after this bullish rally here, post Bank of Japan last rate decision, roughly into this price around 186.3. If this next daily candle ends up clearing these lows on the candle bodies here, we could see a short-term corrective pullback phase to retest previous highs as a lower buyer demand zone around the 183.5, 184 handle before accumulating more buy-side volume and extending the trend. So one thing we have to look out for is, even though it's very easy to just say GJ's bullish, we understand why from a macro fundamental perspective and why from a technical perspective. One thing we have to be mindful of is the secondary phases of market structure, which are corrections, pullbacks, or consolidation phases, right? So we can assess that we're getting some signs of buyers' exhaustion after this rally around these intraday highs. Now, if we break below 185, it looks like an intraday pullback wave that can easily be retesting into 183.5 before extending higher. Otherwise, if we fail to break this area and start to just come back above 186 and the last intraday highs, we have confirms just to extend trend further. So these are the trade ideas, understanding what would tell us a pullback phase taking place. $183 is those previous highs, and we can see some nice intraday liquidity zones around this price sensitivity area. But for that, we need to be breaking well below 185 to be retesting into 183.5 before continuing more bullish, like we're looking at in the daily time frame there. Otherwise, if the daily just makes a lower wick, fails to really trade lower or even retest into this area, we come back above 185.8 and above these highs, just continue the bullish bias, scaling above accordingly through the PPLs, still maintaining bullish structure, bullish bias, no signs of a more aggressive pullback phase to retest better buyer demand zones. Now, one thing we have to look out for is the UK PMI data, which can lead to some of these data-induced liquidity grabs and short-term downside on GJ on the intraday, but not fading out the macro sentiment, macro structure. That's why we call them data-induced or event-induced liquidity grabs and price setups. Now, Euro USD, obviously, we've been playing overall dollar strength as your world reserve currency. And if we maintain this dollar strength, it looks like we have pretty clean-cut moves to be trending down, mirroring this type of price action to the downside here, which is very common. You can even see not exactly the same, but very similar accumulation zones here, very similar cancellation of the upside price action. So give or take with the data price grabs, it still looks like we're going to be chugging away in this type of inverse price formation down into the 1.08s and 1.075s. The one thing we have to be cautious about is if we have bad US economic data tomorrow, it's going to lead to an aggressive data-induced liquidity grab, which can easily come back into the 1.088s before getting faded out more on the macro. But obviously, that's still time away. For the time being right now, just through Asian session and European session, we'll be looking for retests of 1.087, breaks below 1.084, continued sells, mindful of data-induced liquidity grabs through New York that could even retest into the 1.09 area, 1.089 area before getting faded out. I would also love to see further confirms and confidence in this positioning by seeing dollar index printing some new intraday highs. But just be careful with how dollar upside volatility has been subdued. You're going to see that same type of correlation where you're going to get these aggressive pullback waves on dollar pairs. So be mindful of these pullback waves that can retest better intraday sell zones, set up better prices, and then fade out those pullback moves. GBPUSD has held a little bit more bullish, but is still showing major signs of sell orders being accumulated from our pre-planned area of 1.28. If we break below 1.27s, it looks like clear-cut runs to these previous intraday lows around 1.26s. Declining UK PMI data would also further support this with some GBPUSD downside. Give or take some minor pullback phases, as we've had very sporadic intraday price action with liquidity more on the sidelines and dollar upside volatility subdued as markets, of course, await some of the more important events and the Jackson Hole Symposium. But don't see any reason for buys unless we're above 275. Otherwise, looking for pullbacks and these sells below the intraday zone and sells below key level at 269. Now, these are trade ideas which are just taken into consideration current sentiment, structure, and events in play. We still always have to keep an eye out on headlines for any reactive events that can impact sentiment, either add on to it and support our bias, or potentially take away from it, and we have to adapt accordingly as manual retail traders. USDCAD, we've been riding that bullish bias on the macro ever since the 1.32 prices here. Still looks like very similar to dollar. We can be extending up to 1.36s, 1.37s, give or take some data-induced pullbacks with the volatility we have with economic reports this week and the Jackson Hole Symposium, plus dollar upside being subdued, with any urgency on dollar upside having countries like China and India jump in to do some currency interventions. But overall, we've still been playing that USDCAD bullish bias, which would be further supported at the end of the week if Jay Powell fades out those rate cut hopes for 2024. Would love a deeper data-induced pullback wave to 344 before continuing better buys, or just extending above these highs, continuing trend, continuing structure. Trend is your friend. No reason to fight it, especially when you understand the fundamentals support it and what's going on the higher time frames. USDJPY would love a nice retest of this accumulation zone at 145. Breakouts above 146, breakout above 146.4. I can still see us chugging away in slow and steady fashion to the 150s. We still have the rate differential between the Federal Reserve and the Bank of Japan. No new fear, uncertainty, or doubt on a global geopolitical perspective or financial sector perspective that's actually impacting markets or holding significant weight to intraday order flow. Still very bullish in price action, bullish in market structure. Now, US 30, this new daily candle has no lower wick, but we have to be very, very careful here. Easy, safe continuation sells below 34,250s. Bad US data taken away from the soft landing narrative. Still having some of this banking sector fear in the US with the S&P downgrades. And of course, seeing a bit more life in the volatility index while maintaining this correction and bearish sequence of events. But otherwise, something we have to be cautious about is very aggressive, greedy buyer dip phases where if we do not break below this prior liquidity zone or really trade below it, it's difficult just to see continued downside straight to the 33,600s without some type of aggressive buyer's trap or dip being created here. So I wouldn't be surprised if we fail to break the lows that you could get these bullish bounces, dead cat bounces, a buyer's trap getting faded out back around 34,900, 35K before still continuing sellers in control. Otherwise, if we just break below, I'd anticipate the easy clean sells, Jackson Hole Symposium to lead to some volatility in a dead cat bounce, Jay Powell stick to fading out rate cuts and then continuing lower. So the one thing I want to be mindful about is just an aggressive pullback phase or dead cat bounce that can take place here on US 30, right? So if we break above 34,500 and 34,600, I see that dead cat bounce, price setups for Jackson Hole Symposium, buyer's trap being set up, and potentially fading it out around those range low retests and accumulation zone roughly at 35K, 34,900. Otherwise, I only see the safe continuation style plays with clean breaks below 34,200, which is just continuing rates up higher for longer narrative, the continued outflow with the whales liquidating positions on equities from those intraday highs, VIX picking up a little bit more steam, breaking below this technical price point at 34,200. It's almost been an hour webinar, 45 minutes. Don't want to ramble too long, as yesterday's was like an hour and a half because we were just ranting about the current economic situation, social political stuff, fundamentals, and just answering questions. But that's it for today. I'll see everybody tomorrow morning for our New York scalping session live. And make sure new members go through the educational webinars review all the content over the last couple of weeks. Markets have been choppy, which we already anticipated on gold, US equities on the intraday timeframes here, and dollar at the start of this week, as we have more important events in the second half and market focus on Jackson Hole Symposium. But we remain adaptive. We remain fluid with the markets. We've just decreased our risk, aggression, and the quantity of trades this week. And we're waiting to place some of that volume and volatility with fundamental catalysts.